when you think about the growth investing landscape, about a year ago, as a rough benchmark, you probably wanted to see companies growing 100% or more year over year to be interested in them. Now, when you look at companies, are you okay with, say, 50, 60% growth? Is that the new 100% given the macro environment? Or how do you think about the bar that you set for growth expectations right now?
Well, one thing that I'm spending a lot of time thinking about is that maybe I'll make one point, which is like a reason I really like enterprise software is if you look at like all the enterprise software businesses that have ever gone public, on average, they've raised about $1 of capital per dollar of ARR that they put up. Now, of course, that's a positively biased sample set, but you could have a really interesting intellectual debate about whether a software business generically is worth like 4 or 5, 10 or 20 times ARR. Sort of depends on where you are in the cycle and what the business is. But like, if you only spend $1 and it is worth one of those numbers, like there's a positive return on invested capital, which is different than a whole lot of other business models that were funded by the growth and venture community over the last several years. And so I'm generally of the view that if you can predictably put dollars out the door and put $1 of ARR point on the board per, dollar, like that is a good idea that creates value in the world. Where I think the bar for me has risen, because to Eric's point, capital is more expensive, is like how certain, like what level of certainty do you have around that? And I think like where more difficult decisions are made, or like an uncertain dollar out the door that may create $1 of revenue, but also like very much may not. I think I've seen a lot of companies cutting back there, but I think it's a mistake to cut back on growth rate, like because suddenly the public market rewards Rule of 40 more. Because in the long run, putting ARR points on the board reasonably efficiently that are worth like way more than what you burned to put them on the board is generally speaking a pretty good strategy. One thing I'm spending a lot of time thinking about are dividing enterprise software businesses into like those that are secular, like a toolkit to think about what the secular growth rate of a business is during a recession, right? And there are some enterprise software businesses that are incredibly sticky, incredibly hard to rip out, don't have consumption-based pricing, but even they'll face like some seat-based like net retention headwinds and sales cycles will elongate. Then there are others, maybe some are driven by mortgaging volume in the United States, maybe some are driven by like e-commerce volume, whatever, where there are likely to be deep cyclical sort of headwinds over the next 3, 6, 9, 12 months. But the secular growth rate, over a cycle may actually continue to be quite strong. And so working with management teams and thinking just around prospective investments of the businesses that have the greatest delta between what the printed growth rate is and what like the actual secular growth rate that they're demonstrating in, a more cyclical end market, I think is a toolkit that will become more and more important to investors and some operators over the next year or two.